Hey everyone, have you ever Googled Bitcoin because you were scared? That fear? That's exactly where fortunes are quietly being made. Because right now, as you're watching this video, millions of Americans are doing exactly that. They're typing Bitcoin is dead into Google at a rate this country hasn't seen since the day FTX collapsed and took billions of dollars down with it. That's not my opinion. That's Google's own data. Live today, February 21st, 2026. And here's what gets me. Every single time. That search phrase has spiked in Bitcoin's history. I mean, every single time. The people who hit that search bar were actually standing at the edge of one of the greatest financial opportunities of their lives. And most of them walked away from it. They walked away scared. They walked away convinced the story was over. And then they watched, from the sidelines, as the next chapter began without them. Now, I'm not here to tell you what to do with your money. This is not financial advice. Please understand that clearly from the start. But I am here to make sure that if this moment turns out to be what I think it is, what the data is quietly whispering it might be, you are not the person who looks back 6 months from now and says, I knew something was happening, I just didn't act. That feeling is one of the most painful things a person can carry, and it is completely avoidable if you pay attention to the right things right now instead of the wrong things. So get comfortable, turn your notifications off, because the next 15 minutes could genuinely reframe how you see what's happening in Bitcoin right now. Let's get into it. All right, let me give you the honest picture first. No sugarcoating, no cheerleading. Bitcoin right now is sitting around $68,000. It is down 23% since January 1st. In the first 50 days of 2026, Bitcoin has performed worse than any 50-day opening stretch in its entire 16-year history. We have never, not once, seen Bitcoin lose ground in both January and February back-to-back. Until now. So yeah, it's been ugly. I'll be the first to admit that. But here's what I need you to understand about ugly markets. Because this is something Wall Street has known for decades, that most retail investors never figure out. The narrative and the reality are almost never the same thing at the same time. When things look the worst on the surface, when the headlines are screaming, when your neighbor is talking about Bitcoin being finished, when Google searches hit the panic button, that is almost never the moment the story ends. Most of the time, that's actually where the next chapter quietly starts. Not with fireworks, not with announcements. Quietly, in the dark, while everyone's looking the other way. Now, a little context matters here, because when people say Bitcoin is crashing, they're technically correct. But what they're leaving out is the why. Bitcoin hit an all-time high of $126,000 in October of last year. $126,000. If you go from $126,000 to $68,000, yes, that's a brutal pullback. But that pullback happened from a peak that no analyst on Earth predicted would come that fast. The question that nobody's asking right now, and the one I think is actually the most important, is not, is Bitcoin going lower? The question is, who is doing what with their money while everybody else is panicking? And that answer, my friend, is where this gets genuinely interesting. I want to tell you about something that happened in the last 48 hours that most people completely missed, because it wasn't in the headlines and it wasn't trending on social media. On the Bitcoin blockchain, which is completely public and transparent, anyone can see it, a wallet address that had not moved a single coin in 5 years suddenly woke up. Think about what that means. 5 years of silence. That wallet survived the 2022 crash, the FTX collapse, the recovery, the all-time high at 126,000, and said nothing. Didn't move an inch. And then today, it transferred 1,000 Bitcoin, roughly $67 million, to an exchange. Now, I'm not going to pretend I know that person's exact reason. On-chain data shows movement but cannot confirm intent, and I want to be transparent about that. But let me ask you a logical question. When someone who has held Bitcoin since 2021 and has sat through every storm since suddenly moves $67 million to a place where you can sell it, what does that tell you about where they think the price is headed in the short term? At minimum, they're taking profit. And you don't take profit unless you think the near-term path might be downward first. That's just the logic of the trade. But, and this is the part most people miss, that's only half the whale's story. Because at the exact same time that Wallet was moving coins to an exchange, something completely different was happening on the other side of the blockchain. A completely separate transaction moved 3,107 Bitcoin, over $200 million, into Coinbase Institutional. Not Coinbase, the regular trading app, Coinbase Institutional, the platform that American hedge funds, family offices, and institutional money managers use to build positions. That is a buying platform, not a selling platform. So on the same day, you had a $67 million whale depositing to sell, and you had a $206 million institutional buyer quietly accumulating at these prices. That's not confusion. That's a market in transition. That's the tug of war between the people who are tired and the people who are patient. And it gets deeper. There's a single trader. His name is Garrett Jin. He's been tracked by blockchain analysts for months, who moved approximately 11,000 Bitcoin worth $760 million into Binance over the past 2 weeks. And data shows that roughly 60% of those coins were sold. We're talking about nearly $500 million worth of Bitcoin sold by one entity into this market. That's real selling pressure. That's a real reason the price has struggled to break higher. But here's the counterbalance that nobody's reporting loudly enough. Glassnode, one of the most respected on-chain analytics firms in the industry, has been quietly tracking a metric that shows somewhere between 60,000 and 100,000 Bitcoin has been withdrawn from all exchanges combined over the past several weeks, moving to cold wallets, moving offline, moving to places where you cannot sell them quickly. You don't move coins off exchanges if you're planning to sell them tomorrow. The people moving Bitcoin off exchanges believe, at some fundamental level, that these coins are worth more later than they are today. They're not panicking, they're parking. And when you zoom out and look at both stories at once, the sellers distributing on one hand and the accumulators quietly stacking on the other, you start to realize that this is not a market that's dying. This is a market that is transferring ownership, from the impatient to the patient, from the scared to the conviction holders. That transfer has happened before, every single cycle. And the people who recognized it while it was happening, not after, those are the people who had the stories worth telling. There's also the matter of an $800 million stablecoin transaction that happened today. Someone moved $800 million in USDT from Binance to an unknown wallet. That kind of liquidity move doesn't happen without purpose. Large stablecoin flows are typically the footprints of big players preparing to deploy capital. Where it goes next, nobody knows for certain. But that capital is moving. And capital that's moving is capital that's getting ready to do something. Let's talk about the ETFs, because this is the part where I think most people watching have been given a fundamentally incomplete story. Here's what the media told you. Bitcoin ETFs saw 5 consecutive weeks of net outflows, almost $4 billion pulled out. BlackRock was leading the redemptions. Institutions are leaving Bitcoin. And yes, all of that is technically true. I won't deny a single number. But here's what the media didn't lead with. Despite 5 straight weeks of withdrawals, 5 weeks, every single US Bitcoin ETF combined still holds $85 billion in assets. BlackRock's IBIT alone is sitting on $61 billion. These products didn't collapse. They didn't get shut down. They didn't see a run on the bank. They absorbed nearly $4 billion in outflows and are still holding 60 times that amount. That's not weakness. That's durability. And then, this is the part that hasn't been reported loudly enough. On February 20th, just yesterday, something shifted. After 3 straight days of outflows, the ETFs recorded $88 million in net inflows. BlackRock put in $64 million. Fidelity added another $23 million. One day doesn't make a trend. I'll say that clearly. Past ETF flows do not guarantee future performance, and I want to be honest about that. But a 5-week waterfall stopping, even for a day, is a data point worth noting. Because trends don't always reverse with a bang. Sometimes they reverse with a whisper, and that $88 million day might have been a whisper. Now here's the psychology underneath all of this that I think is the real story. The average American who bought a spot Bitcoin ETF, your neighbor who got excited in late 2025, your coworker who finally pulled the trigger, your uncle who told everyone at Thanksgiving he bought BlackRock's Bitcoin fund, that average investor is currently sitting on approximately a 20% paper loss. 20%. That stings. I understand why people are pulling money out. When you're down 20% and the headlines say Bitcoin is dead and Google searches are spiking, the emotional pressure to exit is immense. The human brain is literally wired to interpret financial loss as pain, actual neurological pain, similar to physical pain. Studies have shown that losing money activates the same brain regions as physical threat, so your instinct to get out isn't weakness, it's biology. The question is whether you let your biology make your financial decisions. And look, uncomfortable doesn't mean over. Sometimes uncomfortable is exactly where you need to be to capture the kind of returns that make a real difference in your financial life. Just don't make permanent decisions based on temporary emotions. That's not a trading strategy, that's a way to guarantee regret. Okay, this is the section I genuinely cannot wait to break down for you, because what's sitting right below the surface of this market right now is something I haven't seen set up this clearly in a very long time. Let me explain it simply without getting overly technical. Right now, there are an enormous number of traders in the Bitcoin futures market who are betting that Bitcoin is going down. They're called short sellers. And here's the thing about short sellers. They're borrowing Bitcoin to sell it, betting they can buy it back cheaper later and pocket the difference. When a large crowd of short sellers pile into the same trade, something mechanical and inevitable can happen. If the price doesn't go down, if it holds and then starts to nudge up, those short sellers begin to panic. They have to buy Bitcoin to close their positions. And when they all start buying at the same time, it creates a chain reaction that can push the price up violently and fast. That's called a short squeeze. Today, according to CoinGlass data confirmed by on-chain analytics platform Look'nChain, the data shows that if Bitcoin trades above $69,000 and holds there, a total of $864 million worth of short positions will be forcibly liquidated. $864 million of people who bet against Bitcoin being forced to buy it. Now, I want to be careful here. Market conditions can change rapidly and no price movement is guaranteed. I want to be completely transparent about that. I'm not telling you Bitcoin is going to $69,000 tomorrow morning. I don't have a crystal ball. Nobody does. But what I am telling you is that the mechanics are in place. The spring is coiled, and a coiled spring eventually releases. It's just physics. And what makes this even more fascinating is the funding rate data. Without going too deep into the weeds, funding rates in the Bitcoin perpetual futures market are currently negative. What that means in plain English is that there are so many people betting against Bitcoin right now that they are literally paying the people on the other side just to hold their positions. The short sellers are so crowded that they're willing to pay just to stay in the trade. The last time this happened, the last time short positioning was this extreme, was at the 2024 bottom, the exact bottom. And what happened after that? I'll let you connect the dots. History doesn't repeat exactly, but it rhymes in ways that should make every serious person in this space pay very close attention right now. There's a group of people in the Bitcoin ecosystem who are almost never wrong about Bitcoin's long-term direction. They're not analysts. They're not influencers. They don't post on Twitter. They just quietly operate the machines that keep the Bitcoin network running. I'm talking about Bitcoin miners. And right now, in the middle of what the media is calling Bitcoin's worst start to a year in history, the miners just sent a signal so loud that it honestly stunned me when I looked at the data. On February 20th, Bitcoin's mining difficulty, the mathematical measure of how hard it is to mine a Bitcoin, increased by 15% in a single adjustment. That is the largest single percentage jump in mining difficulty since 2021. It broke records. Now, why does that matter? Let me give you the real-world translation. To mine Bitcoin, you have to buy specialized computers called ASICs. They cost tens of thousands of dollars each. You need facilities, electricity contracts, cooling systems. A serious mining operation is talking about capital expenditure in the millions or hundreds of millions of dollars. These machines take months to order, manufacture, and deploy. Mining difficulty only increases when more machines are being added to the network. More machines means more capital deployed. And here's the thing. You don't spend millions of dollars on mining hardware if you think the asset you're mining is going to zero. When miners are adding hardware at the fastest rate since 2021, while the price is sitting 46% below its all-time high, what does that tell you about what miners believe Bitcoin is worth in the future? They're not panicking, they're expanding. And I'll tell you something else. Earlier in February, a string of brutal winter storms across the United States knocked significant mining operations offline, particularly in Texas. The hash rate, the measure of total computing power on the network, dropped significantly. And then the storms passed, and the miners came roaring back. The recovery was so fast and so complete that it looked like a perfect V on every metric that tracks it. The network is stronger than the setback. The miners aren't leaving, they're doubling down. I don't know how to say this more clearly. The people who are paid to understand Bitcoin's fundamentals better than anyone else in the world are acting like this price is a gift. Whether it turns out to be one is for the market to decide. But their behavior is a data point that deserves your full attention. Let me take you back in time for a moment, and I want you to pay close attention to this because I think this might be the most important part of this entire video. In June of 2011, Bitcoin was trading around $30. It had surged from basically nothing in just a few months, and then it crashed, hard, down to $2. And when it crashed, Google searches for Bitcoin is dead absolutely exploded. People wrote obituaries for it. Forums declared it finished. The experiment was over. 12 months later, Bitcoin was at $13, 600% higher than the bottom. In 2014, Mt. Gox, at the time the world's largest Bitcoin exchange, was hacked and collapsed. Billions of dollars in Bitcoin vanished. Bitcoin is dead. Searches went through the roof. The crash was devastating. 12 months later, Bitcoin was recovering. The network was stronger than the exchange that failed. In 2018, after the ICO bubble, Bitcoin fell 84% from its peak. The crash took almost an entire year. Bitcoin is dead. Searches hit levels that seemed like they'd never be exceeded. 12 months later, Bitcoin was building the foundation of the run that would take it above $60,000. In March of 2020, when COVID hit and global markets collapsed in a single week, Bitcoin crashed 50% in 2 days. Bitcoin is dead was everywhere again. 12 months later, Bitcoin was at $55,000. And in November of 2022, FTX, one of the largest crypto exchanges on the planet, imploded in a fraud scandal that wiped out billions. Bitcoin is dead searches hit their then highest level ever. The headlines were brutal. 12 months later, Bitcoin was staging what would become the run to $126,000. Now, today, February 21st, 2026, Bitcoin is dead. Google searches just matched those FTX era highs. For the first time since FTX collapsed, Bitcoin going to zero hit a perfect 100 out of 100 on Google Trends, maximum possible search intensity. I'm going to be very careful here. Past market behavior does not guarantee future results. Every market cycle is different, and I want to be honest with you about that. I am not telling you this means Bitcoin will definitely recover and go higher. What I am telling you is that 14 years of data shows a consistent pattern, and every time that pattern has played out, the people who understood what fear-driven Google searches actually represent were better positioned than the people who believed the searches. The searches don't reflect reality, they reflect emotion, they reflect the maximum point of collective human fear. And maximum collective human fear historically has not been the end of Bitcoin's story. It's been the loudest chapter, right before the next one begins. Make of that what you will. But please, don't make your financial decisions based on a Google search written by someone who made that search at the exact moment they were most afraid. There's something happening in Washington, D.C. right now that most Bitcoin holders aren't paying close enough attention to, and I genuinely believe it could be one of the most consequential events for US-based crypto investors in this entire decade. It's called the Clarity Act. Here's the context. For years, genuinely years, the biggest obstacle to American institutional money fully entering the Bitcoin and crypto space hasn't been the technology or the price or even the volatility. It's been the regulatory uncertainty, the legal gray zones, the question of whether Bitcoin is a security or a commodity, the fear that buying or holding crypto could put a fund manager in legal jeopardy, the inability of banks to offer crypto products without risking their regulatory standing. Trillions of dollars have been sitting on the sidelines, not because institutions don't believe in Bitcoin, but because they couldn't legally move without clear rules. Kevin O'Leary, Shark Tank, you know him, said it plainly. There are trillions of dollars waiting and they cannot move until there's regulation and compliance infrastructure. The Clarity Act would create that framework. It would establish exactly who regulates what, draw the lines between securities and commodities and digital assets, and open the legal pathway for banks, pension funds, endowments, and retirement accounts to participate in Bitcoin. The prediction market platform Polymarket, which uses real money from real people betting on real outcomes, spiked the odds of the Clarity Act being signed into law in 2026 to 90% before settling around 82 to 85%. That is an extraordinarily high confidence level from a market that has real financial skin in the game. Ripple's CEO, Brad Garlinghouse, who has been in Washington, D.C. meeting rooms for this legislation, said publicly that he believes there's a 90% chance this bill passes by April. Coinbase CEO Brian Armstrong, whose company literally depends on this bill, called the latest talks a win-win-win outcome. And Forbes confirmed this week that the White House itself is actively supporting crypto companies in the negotiations. Now think about this from a timing perspective. If the people who know the most about this legislation, who are in the rooms where it's being negotiated, are saying April 2026 and the current Bitcoin price is $68,000 in February 2026, I can't tell you what that means for price. Legislative outcomes are not guaranteed and market reactions are unpredictable, and I need you to understand that clearly. But I will invite you to think about what has historically happened to Bitcoin's price when major regulatory clarity has been announced. Every single time the institutional runway got clearer, the market moved in one direction. Think about where you want to be, or not be, before that door fully opens. And there's one more structural change happening in the background that almost nobody's talking about, but that I think is genuinely significant for where Bitcoin goes from here. CME Group, the world's largest derivatives marketplace, the institution that more serious money managers trust for futures trading than any other, announced this week that starting May 29th of this year, they will launch 24-hour, 7-day-a-week Bitcoin futures and options trading. Right now, CME only operates Monday through Friday during regular market hours. This means every weekend there's a gap in the institutional hedging market. Prices can move on Saturday and Sunday without the full infrastructure of institutional participation. That gap has created trading anomalies, volatility patterns, and what traders call CME gaps, price movements over the weekend that the market sometimes comes back to fill during the week. When CME goes 24/7, all of that changes. Bitcoin becomes a fully institutionalized, around-the-clock financial instrument with the same market access as gold futures, oil futures, and equity index futures. That's not a small thing. That's Bitcoin growing up. That's the infrastructure of mainstream finance wrapping fully around this asset. And infrastructure, over time, drives capital. Let me tell you about 3 people who made public statements in the last 48 hours that I think are worth understanding in the context of everything I've laid out so far. Robert Kiyosaki, you know him. Rich Dad, Poor Dad, one of the best-selling personal finance books in American history. Yesterday, he went on X and told his millions of followers that he just purchased one full Bitcoin at $67,000, not a fraction, a whole coin, while it was actively declining. And the two reasons he gave weren't hype. They weren't about getting rich quick. He said he believes the U.S. national debt is accelerating toward a crisis point that will force the Federal Reserve to print money on a scale that will devalue the dollar aggressively. And Bitcoin has 21 million coins. That's it. That cap doesn't change. Governments can print dollars indefinitely. Nobody can print more Bitcoin. Now you can agree or disagree with Kiyosaki's worldview. But this is a man with decades of experience in real assets, gold, silver, real estate, publicly putting his money into Bitcoin at $67,000 during maximum market fear. That's not a random decision, that's a conviction. And conviction doesn't mean certainty. It means he's done the analysis and decided the risk is worth taking at this level. And then there's Michael Saylor. Strategy, his company, just purchased 2,486 Bitcoin last week alone, $168 million at an average price of $67,710 per coin. His total holdings are now 717,000 Bitcoin. His company has an unrealized loss of over $2 billion on paper right now, and he is still buying. Let me say that again slowly. Over $2 billion in paper loss, still buying. Now you can call Saylor delusional. That's fair. Smart people disagree about him. But consider this. The alternative explanation is that he has done more due diligence on Bitcoin's fundamental value than virtually any other entity on Earth, and what he sees at the end of that analysis is a number considerably higher than $68,000. Following any individual's investment behavior is not a strategy, and please don't treat it as one. But understanding what the most convicted long-term holders are doing at this price level is valuable information, and the answer is clear. They're buying. And then there's the anonymous $206 million flow into Coinbase Institutional 2 days ago. Nobody knows who it was, nobody made a headline about it, but the blockchain is public and the transaction is undeniable. Large, quiet, institutional accumulation at $68,000. The people who move quietly without announcements, without Twitter threads, those tend to be the people who are the most serious. The loudest voices in Bitcoin are usually the most emotional. The quietest moves are usually the most intentional. I want to talk about something that most casual Bitcoin investors barely think about, but that every serious long-term holder understands deeply. Bitcoin has a built-in event called the halving. Every 4 years, approximately, the reward given to Bitcoin miners gets cut in half. This means the daily production of new Bitcoin gets cut in half. And historically, not every time, not perfectly, not on a predictable schedule, but historically, the 12 to 18 months following a halving have coincided with Bitcoin's most significant price appreciation periods. The last halving was in April 2024. That's 22 months ago. 18 months after that halving, Bitcoin hit $126,000 at its all-time high in October of last year. That was almost exactly on the historical schedule, not perfect, but close enough that it's hard to dismiss as coincidence. Now here's the part of the cycle that's less fun to talk about, but equally important. After every halving cycle peak, there has been a correction phase. And that correction phase has historically lasted between 25 and 30 months post-halving before the market finds its structural bottom and begins rebuilding. 25 to 30 months post-halving puts the potential cycle bottom somewhere between June and October of 2026. We are currently at month 22. I'm not telling you the bottom is in. I am not saying we can't go lower. The Bitwise CIO, one of the most respected analysts in institutional crypto, said this week that he believes there may be one or two more significant shakeouts before the cycle's real bottom forms. Cycle analysis is based on historical patterns and is not predictive of future price. I want to be clear about that. But here's what I want you to hold on to. If the historical cycle plays out even roughly the way it has 4 times before, then we are somewhere between 3 and 8 months away from the window where the next long-term opportunity begins to close. Not open. Close. The window opens quietly. It closes loudly. And by the time it's loud enough for everyone to hear, by the time the Google searches shift from Bitcoin is dead to should I buy Bitcoin now, most of the entry opportunity will already be gone. That's not a threat. That's just how markets have worked. In Bitcoin, and in every other asset class, for as long as markets have existed. Before I wrap this up, I need to mention something that I've been watching very carefully over the past week because I think it has implications that reach well beyond Bitcoin. A firm called Blue Owl Capital, one of the largest private equity firms in the United States with over $300 billion in assets under management, was forced to sell $1.5 billion in assets this week and permanently halted investor redemptions from one of its private credit funds. And Mohammed El-Arian, former CEO of PIMCO, one of the most credible financial voices on the planet, publicly compared this situation to the collapse of 2 Bear Stearns hedge funds in 2007, the ones that collapsed a year before the 2008 financial crisis. Now, I want to be measured here. One private credit fund is not the 2008 financial crisis. I am not predicting economic collapse. Macro analysis does not constitute financial or investment advice, and I need to be transparent about that. But I want you to understand something about Bitcoin's origin story. Bitcoin was created in 2009, literally in the immediate aftermath of the 2008 global financial meltdown, as a direct response to what happens when governments and central banks have to bail out a failing financial system. The person who created Bitcoin published its first block with a message embedded in the code, a headline from that day's newspaper about bank bailouts. Bitcoin wasn't created for bull markets. Bitcoin was created for exactly the kind of environment where the traditional financial system shows cracks, where trust in institutions erodes, where the response to financial failure is money printing. If, and I emphasize if, this blue owl situation is the beginning of something larger in the private credit market, Bitcoin's narrative doesn't weaken. It becomes the most compelling it has ever been. I'm not hoping for a crisis. Nobody should. But I am watching this space carefully. And I think you should be too, because the thing about financial dominoes is that nobody announces when the first one tips. You either see it in advance or you read about it afterward. There's one more piece of this puzzle that I want to give you before we close, because it matters specifically for the next 6 days. On February 27th, 6 days from now, $7.3 billion worth of Bitcoin options contracts expire on Deribit. Options expiry events are important in Bitcoin because they create what's called max pain, price gravity, the price level at which the maximum number of options expire worthless, benefiting the market makers and large institutions who wrote those contracts. The max pain level for this particular expiry is $75,000. Now that's not a prediction. Prices don't always move to max pain. Options market mechanics are complex and do not guarantee price movement. Please understand that clearly. But it is a gravitational force. And when you combine a max pain of $75,000 with $864 million in short positions that get liquidated if price crosses $69,000, you start to understand why the next 6 days in Bitcoin might not be as quiet as the last 22 have been. There's also something worth noting on the bearish side, because I want to give you the complete picture. The single largest put option in this entire expiry has a strike price of $40,000. Someone, a very well-funded someone, has placed a significant bet that Bitcoin drops to $40,000. I don't know who it is. Neither does anyone else publicly. But that position exists. It's real. And it represents a scenario that, while I think is unlikely based on current data, cannot be completely dismissed. Stay informed. Stay balanced. Don't let any single narrative, bull or bear, turn off your critical thinking. The market rewards people who think clearly more than it rewards people who think hopefully. All right, let's bring this all the way home. Here's what we covered today. Bitcoin is sitting at $68,000. The worst year-to-date performance in its history. Google panic searches are at post-FTX highs. The market is in 22 consecutive days of extreme fear, and underneath all of that noise, whales are moving hundreds of millions into Coinbase Institutional. 60 to 100,000 Bitcoin is being pulled off exchanges and locked away. Michael Saylor spent $168 million buying Bitcoin last week at these exact prices. Robert Kiyosaki bought a coin at $67,000 while everyone else was searching, is Bitcoin dead? Bitcoin miners just deployed more hardware than they have since 2021. And they don't make capital decisions based on 60-day price charts. The U.S. Clarity Act sits at over 80% pass probability on real money prediction markets, with a target date of April 2026. CME Group is launching 24/7 Bitcoin futures trading in May, and $864 million in short positions are sitting like a loaded spring just above the current price. None of this is a guarantee. None of this is a promise. Cryptocurrency markets are volatile and unpredictable. Never invest more than you can afford to lose. This video is for educational and entertainment purposes only, not financial advice. Always consult with a licensed financial advisor before making any investment decisions. I want that on the record, and I mean it sincerely. But here's my honest take, for whatever it's worth. The moments in Bitcoin's history that mattered most, the ones that changed people's financial trajectories, were never obvious when they were happening. They felt exactly like this: uncomfortable, uncertain, scary, covered in bad headlines and panicking Google searches. The people who look back with no regrets are almost never the ones who had perfect information. They're the ones who did their homework, kept their emotions separate from their analysis, and had the patience to hold a conviction when the crowd was running the other direction. And I want to say something directly to the people watching this who are already in Bitcoin and feeling the weight of this market. Don't let this period destroy your conviction if your conviction was built on solid reasoning. Panic is expensive. Clarity is priceless. The people who sold Bitcoin at $2 in 2011 because of the fear, do you think they're happy they did? The people who sold during the FTX crash because everyone said it was over, how are they feeling right now watching from the outside? I'm not dismissing the pain of this market. I live in it too. But pain is not a signal to quit. Pain is a signal to think harder. And if you can think clearly when everyone around you is thinking emotionally, that is genuinely one of the most valuable edges you can have in any market in the world. The market is not your enemy. The market is an environment. And in that environment, the people with patience, information, and emotional discipline consistently outperform the people who let fear or greed make their decisions for them. You're watching this video, which means you're trying to get informed. That already puts you ahead of the majority. Don't squander that by letting the next 10 minutes of emotion override the last 15 minutes of information. I'm not telling you what to do. I'm showing you what I see. What you do with that information is entirely your decision, and it should be, because it's your money and your future. But if there's one thing I want you to leave this video with, it's this. Don't make a permanent decision at a temporary emotional extreme. The Google searches will cool down, the headlines will shift, the fear will pass. It always has. In 2011, in 2014, in 2018, in 2020, in 2022, it always passed. And every single time it passed, Bitcoin was eventually higher than where the fear peaked. Now, whether that happens again this time, I genuinely don't know. Nobody does. But I know that operating from a place of calm, informed analysis has historically been a better strategy than operating from a place of panic. Every time, without exception. And the cost of being wrong while staying calm is manageable. The cost of being wrong while panicking is devastating. Drop a comment right now. Buy, hold, sell, or watching. Just those words. No explanation needed. I want to see where this community actually stands today, not 6 months from now when hindsight makes everyone look like a genius. And if you found something in this video that reframed the way you're looking at this market, if one piece of the puzzle clicked differently than it did before you hit play, share this with someone who needs it. Not because I want views, but because the people closest to you deserve the same quality of information you just got. Knowledge shared is the only thing in this market that doesn't depreciate. And if you're not subscribed yet, look, I get it. There are 1,000 Bitcoin channels out there. But if this video made you think harder than the last Bitcoin video you watched, then subscribe, hit the bell, and let me be in your corner the next time something big moves in this market. Because in Bitcoin, timing isn't everything. But being informed when it matters, that comes pretty close. I'll see you in the next one.